So the topic for today's webinar is investing in real estate or equity. So which is best? So to give an outlook on this topic, so like both are asset classes which gives you good returns over a period of time. So the thing is, you need to know on which asset class you need to invest, because ultimately both the asset classes give returns and your ultimate goal is to make money. So both the asset classes have their own pros and cons. So you need to know on which asset class you need to invest based on your financial situation and your risk appetite. And the best answer would be to invest in both asset classes. It's not you need to invest in either one of the asset classes. It's you can invest in real estate and equities. So diversification is an important part. So let's just see the types of investments. So in real estate, there's three types of investments. One is the residential, where you can buy be it as an apartment or as an own house or as a bare land. You can just hold and you can sell it. Second one are commercial spaces, where you buy positions as in the commercial complexes. Third one is REITs. REITs are real estate investment trusts. So just like how a company issues shares, here the builder, issues a lot of units in the form of REITs. So you can buy in small units. So this is an alternative. So this is it's a newly launched investment type. So coming to equity investments, as you know, you can buy either in the form of stocks, mutual funds, and ETFs. So now we'll just get into the pros and cons of the real estate and equities. So the first advantage is in real estate, you buying an own house, for a consumption, you can avoid rents. So that's the first thing. So if you don't have, an own house, you can either save money and you can buy an own house, and for saving you can use equity as an asset class for building the corpus to buy an a real estate. So the second one is rents. So if you have an own house and if you give it for rent, you'll get a steady income from the rents. Third one is the capital appreciation. So holding asset class, be it an equity or a real estate, a good investment will give you returns. So here capital appreciation happens. Fourth point is real estate is an inflationary hedge. So real estate, yes, it's a good asset class and it has outperformed the inflation returns. Meaning, to protect your wealth, you can park your amount in real estate. It doesn't, your value of the amount doesn't depreciate, it appreciates. And it's a tangible asset. So it's a very, very good point, because unlike shares, there's a physical presence. You can consume, you can use it. So sixth point is leverage. Buying a real estate, you can go for loans. Unlike equity, you can't do that. It's very, very risky, because equities are very volatile. And you have the control over the investment. The decisions are taken by you. So if you buy a land, you can build a building and you can use it as an Airbnb or as a PG, or you can construct a house and you can live there. So all the controls and the decisions are taken by you, and you can pass it for your for your children, your grandchildren. So there's an inheritance advantage, and there's a tax advantage, meaning you can write it off as you hold the property, you can write it off as depreciation for your business, and also you can mortgage your loans deductions. And these are the cons of disadvantages in the real estate market. So the first point is maintenance. So as I said in the previous advantages, all the decisions are taken by you. So all the risks also have to be borne by you. So whatever happens with that asset, it's your responsibility. So you have to take care of all the maintenance. And there's also a huge capital required to buy a real estate property. So even if you go with the loans by paying up a down payment, like you need to repay that loan. And generally, like the rents, the yields which you get in India are typically less than 3%. If you rent a house in a very developing part of the area, it will be less than 2% also. And one of the main thing is, like, if it's a building, generally, like, the value depreciates. So like, let's say a price of a new flat and the price of a 10-15-year-old flat will be different. So the value of the building, comes down, but the value of the land appreciates. So that's one of the biggest disadvantages in flats, actually. Because if you see, like, in flats, you're just owning the built up area, not the actual land. So even at the time of, demolitions, you'll just be getting the UDS, the undivided shares, which will be typically very low for a flat. And there's a lot of encroachment and legal cases which might happen in the future. And there's a lot of transaction costs. Like, let's say, even if you buying or selling a real estate property, like, you'll be incurring a lot of transaction costs, a lot of commissions, and a lot of you need to pay a stamp duties as well to the government. And generally, like, selling a real estate property is very difficult compared to equities. So finding a buyers are very difficult. It might take months or even years to sell a property. And in the form of rates, like, they are subjected to market risk because they are linked products, and they are subjected to real estate market cycles also. So now let's get into the advantages of equities. So generally, like, buying and selling are very easy because there's a lot of buyers and sellers involved be it in a stock or a mutual fund. So and there's one more thing is, like, you can buy in small parts and sell in small parts, as and when you need, as per your requirement. This is not the case in real estate. Like, if you have a own house, like, if you have a property, you need to sell in a big chunk has to be sold off. So this is one thing. And, like, inside an equity portfolio, you can diversify, actually, across sectors and across categories, and there's no direct management involved. So be it taken a stock or a mutual fund. For a stock, there's a company, and the management runs the company. They take their decisions. And even for a mutual fund, like, there's a fund manager appointed to take care of that particular fund. And the fourth point is dividend yield. So, like, all the companies, like, based on their profits, like, they declare, like, on the profits dividends. So now let's get on to the disadvantages of equity. So one of the major costs you pay by owning equity as an asset class is, like, volatility. You need to, like, the markets will test your portfolio in a major way. So this is what happens. So even, like, on a black swan event, your portfolio can even go 50-60%. So it will be unrealized losses, but it won't be, like, only if you sell it will be a realized loss. So you have to, you might have a good portfolio, like, you might, the valuations in your portfolio might be reasonable, but still, when all of the things falls, like, you can't do anything. Like, even your portfolio will be tested. That's one thing. And the second one is, like, as I said, like, investments, equity mainly are subjected to market risk and economic factors. So directly linked to whatever happening across the world. The decisions taken by the government are directly, like, they're, like, it impacts the equity markets. And there are huge drawdowns. So this is one of the advantages in real estate is like there won't be huge drawdowns, so they are generally stable actually. But in the case of equities, like there'll be huge drawdowns. So now just let's compare the returns provided by equities and real estate. So the chart on the right side, so it will show you what's the returns given by the different asset classes on a different number of time periods in years. So if you take, Nifty 50, like the 10-year returns are 14.7%. Sorry. And And the real estate returns for a 10-year period are 4.4%. On a 20-year period, the Nifty 50 is 14.8 and real estate is 8.2. So on an average, like real estate in even metropolitan cities, the returns, the CAGR is around 8 to 10%. But if you take the case of equities, it will be generally around 11 to 12%. So these are the returns, and this is the chart on the left side is like the returns on the metropolitan cities. So if you see so this is the price compared with the 10-year period. So it's not even like 8% actually. So one of the drawbacks is like on a developed prime area located in the metropolitan cities, like the appreciation won't be huge, but the yield will be better. Exactly. So what is best for you? So like that's a question you need to decide, because like because all of the people are different. They have their own requirements. So different people will be in different financial situations. So people who already have a own house, like they have an advantage because they can save a lot more, of their income, and they can use it for different purposes. Like the best thing I would say is like if you're able to save more and invest, you can do better. Even if you save and invest in real estate, like it would be better. But an effective way, the returns, as you would have seen in the charts, the returns are compared to real estate in equities, the returns are much more better. But the risks involved are also very high. So asset allocation is one of the very most important aspect you need to look into it. So you need to be like diversified. So like in real estate, there will be a lot of costs involved, to maintain, even at the time of buying and selling. So for equities, like it's a very flexible product, but still you can buy in small quantities, sell in small quantities, but still the one of the main thing risk involved is the volatility and the huge drawdown risk. So if you're able to play it safe, if you have a good amount of knowledge, or you have a very good advisor who can guide you, then you can invest a good amount of proportion of your income in equities. So here are some case studies. So like, let's say a professional who wants to, who wants to, use it, who wants to buy an apartment in a prime area of Bangalore. So the purchase cost of the house is 2.1 crores. So he wants to buy and hold that apartment for a good amount of time. He wants to leave it for rent. So he buys a 3 apartment bedroom, and 20% of that property value he is used it as down payment from his own pocket, and balance 80 crores he goes for a 20-year loan. So these are the additional expenses they'll be incurring. So property tax is 50,000 per year, and insurance 20,000, and maintenance charge for a for a gated community would be 30,000, and the EMI would be around 1.25 lakhs per month at 8.5% per annum. So as I was mentioned, even in the charts, like for this 8-year period, it has only given 60% absolute returns, and the valuations of that property is around 3.36 crores. And he would have got a good amount of rent, so which is 60,000, which he has used it for for the part of the repayment of the EMIs. So now, like, one thing is, like, he has taken a good amount of ownership in that property. So he has closed around 2.11 crores in this 8-year period, and only 1.25 crores is outstanding to be completed. So one thing is, like, one of the main takeaways is that, like, there has been a capital appreciation in the property he has bought, which is the apartment, and also he has got stable cash flows, which he has used it for the repayment of the property. So here is, like, one thing is, like, one advantage I would say is, like, he has used the leverage, for owning a apartment. So he has gone with 80% loan, and he has successfully finished around 8 years, and like, now he has around 65%. He is the owner for that house. So one of the main drawbacks is, like, all the maintenance and the tenant management has to be taken care by him, because, like, as I was saying, like, you need to, direct control is on yours. So all the risk involved is also should be borne by you. So this is another example. Like, let's say the same corpus, like, if we invest in a balanced advantage fund. So I'm not even taking a pure packed equity fund. I'm just taking as an example as a balanced advantage fund. As you know, balanced advantage funds, like, you can take the fund manager can take a good amount of exposure in debt also. So according to the market conditions, like, he'll take the decision, he'll take the call if he can, how much he needs to park in equity, how much he needs to park in fixed income. So these are the assumptions I'm taking. So here, like, for the debt component, I'm assuming that the returns would be 7% per annum. And for the equity component in that balanced advantage mutual fund would be around 12%. And the the expense ratio would be around, let's say, 1.5% per annum. And we are also assuming that the dividends are being reinvested. So, like, out of that 60%, let's say 60% is in equity out of the 2.1 crores. So that would be 1.84 crores, and debt is around 40%, which is 84 lakhs of 2.1 crore. So after 8-year period, 12% at 12% per annum returns for the equity component, the 1.26 crore would be around 3.12 crores, and for that 84 lakhs at 7% per annum after 8 years, it would be 1.44 crore. So the current market value of the investment would be around 4.5 crores. So I'm just assuming that the AMC fees would be 1.5%, which would be around 13-15 lakhs. So if you compare both of these cases, like you'd obviously know that like the returns made in equities are far better, but still the risks involved would also be high in the second case, because there would have been a lot of drawdowns happened in the second case, because if you take COVID as an example, definitely the investment market value would have definitely dropped around 20%, even for a balanced advantage fund. That's for one thing. And like there might be some rare cases where even in real estate, like in the at the times of COVID, like there would have been some downward market, but still, like one of the major things is in real estate, like most of the things would be unrealized on a psychological note, since it's very tough to buy get a buyer. You, on a psychological level, you won't decide just to sell your portfolio. But in equities, like since on a daily basis you will be seeing a portfolio, psychologically you'll be affected. You might think that you should sell your portfolio. So that's one thing. In the case of equity, like the volatility will test you. So as much as the brains, you need a stomach to uh, hold it hold your portfolio. That's one thing. So these are the points I was just mentioning. So one thing is like this point is about liquidity. So let's say like both of them have a difficult emergency situation. So they need cash, but still, like they don't need all of the amount they've invested. So at one thing is like what the second scenario person can do is like they can sell 2-3% of their overall portfolio value, which they can meet their emergency need. But still, in the case of like the first scenario, like he can't sell that property. Even the rent amount like is going to it's going towards the EMI repayment. So that's the one thing which equity has over real estate. And there's no direct management involved, unlike real estate. Either a fund manager or the management of the company will take care of the day-to-day operations, as well as the long-term vision of the company. So these are the returns comparison. So on an 8-year period, obviously the returns made by equity are far superior than what the property value raised when compared to equities. So the second point is on the dividends. So sorry, the return yields. So like as I was mentioning, even in prime metropolitan cities, the real estate rental yields are typically uh, 3%. But in US, like the return yields are far superior. It would be around 6-7%, because the interest on what they get in their banks would be typically 0%. And on like there are some types of account where they even get a negative interest. So, but when you compare the returns, what you get in Indian banks, it's generally around 3-4% for a savings account and 7-8% for an FD account. So these are the different things. So in US, generally to make a good interest. That's why a lot of people buy real estate for the rental yields. But in India, if your only motto is to get income from rentals, like that strategy won't be that wouldn't be a great strategy. So these are the market risks. Definitely, an equity-linked product have a higher amount of market risk compared to a real estate. So, like as the returns, the risks involved are also high in equities. So, if you take the case of inflation, definitely like both of the returns made in both of the asset classes have beaten inflation. That's for sure. So that's it from my side. So you can ask questions from your side. Hi, Hassel. Can you take questions? Uh, Hi, Jagannathan. So your question is: people take loans to invest in real estate, but investing in mutual fund and PMS is not suggested. Why? So the basic answer would be like in real estate, as I was saying, the drawdowns involved are very minimal. But in case and till the time of repayment of the house, the owner is the bank and not us. But in the case of, if you're taking a loan for 50 lakhs and you're investing in PMS or a mutual fund, let's say, and generally banks have the concept of margin call. So let's say there, let's say PMS portfolio drops down by 20% of the market value. And then, even if you make returns, you won't be able to repay that loan. So definitely, the banks will margin call your portfolio. So they'll even sell it for a loss. So that's why it's not suggestible for you to take loans and deploy in equities. So most of the real estate return after COVID GT was 50 to 100%, but PPT data shows less return for less than 5 years. Can you explain? So yes, so in the last 5 years, the real estate market has seen an uptrend. So I was saying, so I've taken the data from like for the last 10 years. So this is the difference. So as I was saying, just like an equity market cycle, real estates also have market cycles. So accordingly to market cycles, if you invest, you can see a lot of good returns, but you know, like you need to have a short term vision. And in real estate market investing also, you need to, you know, spend a good amount of time. You need to reach out to different places, and you need to be updated on what's happening on what places.
Hi Akash, thanks. Just to add to that, yes. See, when for real estate, you cannot see 2 3 years. You need to see more. See, for anything that you're sort of parking your money for wealth creation, at that point you cannot see wealth creation in 1 year or 2 years. You have to give it a long time. And last real estate cycle boom was around 2008, 2010, 11, 12. At that point, after that we have not seen that big of a price increase. So if you see what's been happening also on the real estate market, only now, right, there is a big repricing that sort of took place. And usually, when people make a lot of money on the stock market, they would go invest in the real estate, they would go alternates, they would do all of that. So that itself is a cycle. I think there's one question on uh, less return for say 5. I think that's covered, right? Less return. See, if you see, I think the data that he showed also was that I think it grows somewhere around 7 to 7.5%. Your GSEC also is around the same way. So you need to be very cognizant because your capital commitment upfront is very high, and so is your uh, commitment for years together after that. Right? Because you have to pay your EMI, and then there's a lot of stress anyways. Then after that, your savings capacity starts going down because you're doing all of that. Right? Your goal as an investor is to make sure that your potential to save and your savings ratio, that is both, right, should go up. Only then you can have a healthy contribution that goes on to equity and there is a question: is it good to go full home loan and invest the down payment in equity and through HTP settle the MIC? All of these are very complicated. Yeah? You should have a very simple strategy on what you want to do first, rather than thinking of how much to take. First, you see, okay, at every level, let's say they 80/20 or you're 60 or they are 60/40, right? Whatever the ratio might be, how are you going to pay it off? Right? Where are your sources of income for you if there is no equity market, if you don't know anything on the equity, how are you going to pay that off? Right? So proper plan would sort of work for you. And if you want to know, how much should be, your contribution, what should you be doing, how is it that you can pay off, where is it that you need to invest, how much of it needs to go in equity, how much of that needs to go in debt, that we can have a one-on-one discussion. Any data or trends like equity in which years real estate gave negative returns? See, there's no data that comes in. Real estate price discovery is not very high. So, in that area, you see word of mouth works a lot. That's the quotation. Somebody else quotes this much. So, it's very difficult to see real estate from that perspective of when did it give a negative return. Right. If you want, you can look at commentaries that are coming in from real estate listed companies to understand what's happening in the market. And usually, there's no data like this where you have uh, negative returns. You have periods where it does not grow, and you have long periods where it does not grow, right? It's like equity. So but then suddenly, like gold and silver, there'll be a reprice, right? So that's how alternates work. There will be a rebasement. They will come, it will completely change. So that's what happens every time in a cycle, but there is no such data. We looked for it, we've done this, there's no such data. Real estate prices never go down, so capital is always protected. It's not the case with equity also. Very tough to time in equity. Actually, it's very tough to time anything, right? If you buy a real estate property at a very high valuation, scope of appreciation is low. So what you make on it is very low. However, in equity, you actually get drawdowns, and drawdowns when you participate more in a drawdown at a time where India is growing, a lot of things are working for India, and naturally your end result would be higher. Capital can be protected, but capital is not liquid. See, as an investor, you should always think from a perspective of, yeah, I am having a good amount of safety, but I'm also having a lot of liquidity option in this. So anytime a problem comes, anytime I need to liquidate something, it's easy for me to liquidate on the equity market because I just have to go to the exchange and place the order. But for real estate, some can take years for exit. Yeah, some can take years, some can take months. So capital is locked in. I wouldn't say protected. It's locked in. Why can't you time equity markets by trends or charts? It's not about see, as an investor, if you want to be more on the trading side, then your discipline needs to be much higher than what you are as an investor. Then you have to continuously be at the screen from 9:30 to 3:30, right? So it's not the case of timing, it's the case of discipline. If you have that level of discipline, then you can get your timing right as a trader. But nobody has that level of time to actually sit on the screen continuously to understand what's happening to the trends, to look at a lot of data and to understand and interpret that data. That's why I would suggest you give it to people who know it. Work with an advisor is what I would say. You cannot self-diagnose your problems like a doctor. Likewise, you have to work with someone. Okay, you have sent a message. So if you can just put out your number here, and Akash will just get in touch with you immediately after the webinar. Yeah. Akash, please take down this number, and you can get in touch with sir immediately after the webinar.
Yeah, sure.
Okay, there's a question on it's if it's difficult to time equity, how can commodity be possible to time? See, for a commodity, you have to take compulsory delivery. Right? That's not for retail investors, but uh, in terms of understanding charts, commodity charts and currency charts are on the dot. That trends are very much visible there on that front, not on equity. You can broadly see trends on equity, and if you spend a lot of time, or in all the three cases, then naturally you will be able to time it. Gold ornament, see, you can have broad based understandings of macro scenario, micro scenario. For example, see, today Trump is back, and in that case US currency strengthened, but for 2 years, 2.5 years, US currency was weakening. So when US currency strengthened, all the other currencies weakened, right, including gold and silver. Right. But fundamentally, if you see, uh, when a new leader comes, they have to execute, and they have to do a lot of work from the ground up, and it takes time. So whatever excitement, whatever bullishness starts coming in, it sort of fades away in some time, and the rationality again starts coming in based on fundamentals, right? So you have to see trends on the fundamental side, you have to see trends on the sentiment side, and only then take that call of what you want to do. And still you will not be 100% right. You can be some amount of right, but that meter to say if you're right or wrong comes from price. If you enter and then it goes down, you feel like you're doing wrong. If it enters and it goes up, you feel like you're doing right even if you're not doing right. Okay? So don't dwell too much into timing. It's not a You will not lead anywhere if you just keep thinking of timing, right? You can have broad-based understanding that yes, there is weakness, I can participate some. Again, if there's weakness, I can participate more. So as an investor, you only think of participating at levels and where it is where your margin of safety is high, which means that yes, drawdowns, the possibility of drawdowns are lower. That's when you should participate as an equity investor. What is the minimum time period required for equity investing? See, I would say that stay invested for more than 5 years. Only then you see the magic happen. If you don't stay invested for more than 5 years, if you do 1, 2, 3, you'll still see some things happen, but you'll have a volatile journey. Uh, I think that's it. 5+ years is what I would say if you actually want to stay invested in the equity market. Okay, how many years you need to wait to evaluate the mutual fund performance? Uh, See, you usually don't do any switch out or switch in your first year or the second year. Hmm. You understand how the fund has been running. You track the fund, not in terms of performance. First, in terms of what are the changes that are being made, what is the official committee that's coming in from the AMC and the fund manager, right? And uh, see if it is in line with the current portfolio, right? What are they talking about, how they're going to run the portfolio, and only then take that call to wait for a year after that, which is the third or the fourth year, to see how the performance is coming in. After the fifth year is what I would say you evaluate. Milestones to Wealth, what are the services you provide? See, Milestones to Wealth is a behavior oriented program where the services that we are offering are investments on the mutual fund side. That's one. Second, planning services where we will help you to understand, how if you have a particular goal, let's say for retirement, and you need, we first make you understand that this is the amount that is required for you based on your current scenario plus whatever inflation does come in. This is the required amount for you that's good for you to retire. And every month you can sort of withdraw this as your corpus, again, keeps whatever is left out of your SWP grows. Right. So it's a behavior oriented program where we help you save for a particular goal, where we help you save for a particular milestone. If you're setting 5 lakh as a milestone, if you're setting 50 lakh as a milestone, the behavior that goes into a 5 lakh is completely different from that of a 50 lakh. Right. So we help you save and we help you meet your goals. And it's majorly investments on the mutual fund side. We follow a multi-asset approach, regular funds, and uh, we do assist you in terms of planning as well. Okay, there's the next question on at present, which is more attractive valuation, real estate or equity. See, I would say that in India, gold has peaked, as in it has reached all-time high, equity has reached an all-time high, real estate has reached an all-time high. So everything is at those levels where you need to be a little cautious. In terms of equity versus real estate, I would go towards equity for one single reason. One, I get businesses, and my capital is not stuck there. I can get liquidity whenever I want to, and I will get a good dividend yield as well on good businesses. So as and when, if there is more weakness that's coming in on the equity market, I would choose for equity. See, the main thing is, when do you need to buy real estate? After spending a good amount of time of say 10 years to 12 years on the equity market, and having a good amount of corpus, only then I would say that yes, you can go to the equity or real estate market then you have enough capital. You know how things are working, you know how cycles are working, and you know whether you should overpay or not. Okay. Next question is, do we have to wait for 2 years for initial evaluation? What is the point to go with advisor? Your point to go with advisor is that the advisor is only keeping your nerves intact. Otherwise, you'll get anxiety, get antsy, and keep shifting from one place to other continuously. Your advisor is your guide. He is the one who's going to handhold you to take you in the front to not to make sure that you're not doing any decision that's going to work against you, because he understands your risk profile. And at Milestones 12 we take multiple checkpoints. So there is a risk profile that gets done, there is a financial health checkup that gets done to understand what your savings potential is, and help you understand how you can save more. Right? All the decisions are taken only based on your risk profile and your financial health checkup. So everything is tailor made towards you. Your advisor is giving you tailor made solutions just for you, not some Dolo 650 that works for everything, even if it's a headache. Right? So always get help. That 2-3 years to evaluate if something is good or not is not 2-3 years that's actually spent to evaluate. That 2-3 years is for you to get that experience on how a mutual fund is working, and how markets are working, and how to deal with volatility, how to deal when something is doing extremely well, how to deal with something if it's doing extremely bad. So it's that experience that is actually going to help you along with your advisor to take decisions after 5 to 7 years, where you can have that goal that yes, I need to save about 1 crore, and the growth that can come from me is about 6x from there if I hold it for another 10 years. So your 1 crore journey is actually 5.5 to 6 crore journey. Do we need to register separately for all upcoming webinars? Gopi, do you have something? Maybe I'll register. Gopi or Akash, anybody can take this.
Hi, sir. I'll just drop the direct link in the chat box for the upcoming webinar, which is happening at 11 o'clock.
Okay. Next is, do you provide suggestions on fixed income investments like bonds? Yes, we do that as well. So we've done multiple debt webinars. We have a separate debt team. Uh, if you've been on all the older webinars, then Samyukta, she is the principal of the fixed income side. So she does a lot of content on fixed income and on Milestones2Wealth, depending on what your goals are, depending on what the plan is. Yes, we do fixed income investments as well. We do it via mutual funds, and if you do have that requirement that yes, you have the appetite for a bond, we will do a bond as well, no problem. Okay, we'll keep the floor open for another couple of minutes, and then we can close. Okay, I don't. Okay, there's a question. There is a legal problem involved in real estate. while we purchase and inheritance of property, it requires legal consultation before you invest large amount of money. Yeah, there are some disputed properties. Yeah, the work that goes on to real estate is very long, elongated, painful, stressful. So yeah, so you need to be ready then that yes, I need to do a lot of these things. My upfront commitment also will be on the higher side. Okay, I don't think that we're getting any further questions. Thank you all for joining in on Saturday morning. We will continue to do, good content. We are covering themes. We are covering a lot of topics now. We are getting more and more specific into questions that we receive and making sure that we make the content very easy for everybody to understand and have a very fruitful Q&A discussion. Right? Thank you so much. If you're not on the program, get on the program right now. There's a lot of work that's going in. Our teams are expanding, and our offerings and services also definitely will start going on. So thank you all. Have a great weekend ahead.
Thanks, Arshil. Thank you all for joining. So if you have any further queries or if you want to know more about what we do on I Thought and at Milestones2Wealth, so you can drop a message or you can drop a mail or even call to a central number. Thanks for joining. Thank you, everybody.